Usually, when you talk about a medical diagnosis, there is a certain expectation of, clinical precision.
Right.
It feels fundamentally akin to engineering. I mean, you fall off a bike, your arm swells up, and the X-ray shows a very distinct, jagged white line across the radius bone.
Yeah, exactly.
And the doctor simply points to the illuminated film and says, well, there it is. The fracture is visible, it's undeniable, and entirely separated from any surrounding noise.
The human brain really craves that kind of binary diagnostic environment. We want things categorized neatly into broken or not broken, right? Effective or ineffective.
Totally.
Because it provides this psychological comfort to know that the evidence of a problem or the evidence of a solution can be isolated and viewed in a vacuum.
But then you step out of the hospital and into the world of financial market prediction,
Oh, yeah.
specifically, the realm of objective technical analysis and algorithmic trading, and you quickly realize that your diagnostic X-ray machine is just utterly shattered.
It's completely broken.
Right. We are suddenly operating in a landscape that is profoundly murky. I mean, you run a trading algorithm through historical data, and it spits out this beautiful equity curve showing a 15% annualized return.
Which looks amazing on screen.
It does, and the instinct is to point at that curve and say, there it is, the strategy works, but you can't actually do that, can you?
You absolutely cannot. And the reason is foundational to understanding quantitative finance. When you look at the historical returns of literally any trading rule, you're never looking at a pure measurement of that rule's intelligence.
Okay, so what are we looking at then?
You are looking at a final output that is an inseparable tangled mixture of two things: genuine predictive merit and pure random luck.
Just luck.
Yeah, and the diagnostic challenge is that there's no chemical separation process. You can't just look at a 15% return and immediately know if, 14% of that was brilliant market timing and 1% was luck.
Or if the entire 15% was just a massive statistical fluke. Which brings us to the core mission of our deep dive today. We know you, the listener, already have a solid baseline. You understand the mechanics of moving averages, you know how backtests are constructed, and you are ready to really step up your game.
We are getting highly technical today.
We really are. We are ripping the hood off of objective technical analysis to explore the rigorous statistical engines detailed by David Aronson's foundational research on evidence-based technical analysis.
Chapters 5 and 6, specifically.
Right. We are going to explore the granular mathematical reality of how we separate true predictive merit from blind luck.
And, the stakes here extend far beyond academic curiosity. In our current era of frictionless computing, anyone with a laptop can build a trading rule that looks like an absolute money-printing machine in a backtest.
Oh, for sure. You run the optimization, the hypothetical equity goes straight up, and the dopamine hit just convinces you that you've discovered market magic.
But without the specific application of advanced statistical inference, you are not looking at magic. You are systematically mining fool's gold. And deploying real capital behind it is a recipe for catastrophic drawdowns.
So to protect against that, we are going to deeply explore two interconnected domains today. First, how you statistically isolate and test a single algorithmic idea to see if it holds water.
Which is Chapter 5.
Right. And second, we will confront the massive, often catastrophic mathematical biases that erupt the moment your computer tests multiple ideas simultaneously.
And that's the dark reality of Chapter 6.
Exactly. We aren't going to just skim the surface here. We are going directly into the mathematical mechanics of how these concepts are executed. And to keep this highly technical material anchored, we will use one central analogy for each of these two chapters to make it crystal clear.
I think the progression of these mathematical concepts actually forms a really compelling narrative about human fallibility and statistical rigor. By the end of this deep dive, the way you view a backtest will fundamentally shift.
It ceases to be a promise of future wealth, right?
Yeah, it becomes a highly suspect claim that requires an immense burden of proof.
So let's establish our inciting question. Let's say you build a trading rule. Maybe it's a volatility breakout system.
Okay.
You run it over the last 5 years of S&P 500 daily data, and it generates a 10% annualized return. How do we actually determine if that 10% is the result of the rule possessing a genuine edge, or if the rule simply stumbled into a favorable sequence of random market noise?
Well, the answer is that we have to put the rule on trial.
I love that.
Statistical inference essentially performs two distinct but related procedures to conduct this trial.
Mm-hmm.
The first is hypothesis testing, which asks a binary question: is an effect actually present?
So in our context, does this trading rule possess any predictive power whatsoever?
Right. And the second procedure is parameter estimation.
Right.
If we determine that an effect is indeed present, we then ask, what is the actual size or magnitude of that effect in the real world?
And we measure that magnitude using confidence intervals. Okay, to make the mechanics of hypothesis testing crystal clear, I want you to visualize this entire process as a rigorous criminal trial. This is our first anchoring analogy. Statistical testing operates exactly like a courtroom.
It really does.
In any trial, you have two competing, mutually exclusive claims about reality. You have the presumption of innocence, and you have the prosecution's aggressive claim of guilt. In the statistical courtroom, that presumption of innocence is called the null hypothesis.
And in the specific context of evaluating a trading rule, the null hypothesis, or H0, assumes that the rule is completely devoid of merit.
It's just innocent of having any predictive power.
Exactly. Mathematically, the null hypothesis asserts that the rule has an expected return of 0 or less than 0 over the immediate practical future. It is the absolute baseline assumption of worthlessness.
Standing in opposition to that is the prosecution, which is the alternative hypothesis, or HA. The prosecution points at the rule and declares this rule is guilty.
Guilty of possessing genuine predictive power.
Right. And its expected return is strictly greater than 0. But the jury in this courtroom cannot simply take the prosecution's word for it, right? They require tangible evidence.
And the historical backtest data, that 10% annualized return over 5 years, well, that serves as the physical evidence presented to the court.
But the evidence alone isn't enough. I mean, you need a standard of proof. In a criminal court, that standard is beyond a reasonable doubt. In our statistical courtroom, the threshold for reasonable doubt is codified as the p-value.
Yes, a p-value.
It is the exact mathematical metric the jury uses to decide if the 10% return is strong enough evidence to convict the rule of having actual merit, or if the evidence is weak enough that it could just be a coincidence, forcing them to let the rule go.
The architectural logic of how this trial is set up actually requires some deep unpacking. Because a common intuition is to ask, well, if what we actually care about is proving the rule works, why do we focus all our mathematical energy on testing the null hypothesis?
Yeah, why not build a test that directly evaluates the alternative hypothesis? That feels like the most direct route. If I want to prove my volatility breakout system makes money, I should test the claim that it makes money.
It sounds logical, but the problem with that direct route is a profound mathematical impossibility.
How so?
The alternative hypothesis does not make a single specific claim. It makes an infinite number of claims.
Oh, I see.
Right? Because if a rule truly has predicted power, what exactly is its expected return? It could be 1.2%, it could be 5.8%, it could be 40%.
You literally cannot construct a statistical formula to test an infinite matrix of possible realities simultaneously.
Exactly. The null hypothesis, conversely, provides a singular, anchored, mathematically testable claim. The return is exactly 0. 0 is a fixed point. We can build an entire mathematical architecture around 0.
This necessitates the use of what statisticians call the method of indirect proof. Since we can't directly prove the infinite possibilities of the alternative hypothesis, we just assume the null hypothesis is absolute truth. We assume the rule's expected return is exactly 0.
And then we look at the evidence, our 10% back-tested return.
Right. If the probability of getting a 10% return in a universe where the rule's true return is 0 is microscopically small, we reject the null hypothesis.
By destroying the assumption of worthlessness, we indirectly prove that the rule must have merit.
That's fascinating.
And this indirect method leans heavily on the philosophical bedrock of the principle of simplicity, which is essentially Occam's razor applied to data.
Simpler explanations are always statistically more likely to fit a set of observed data purely by chance.
Precisely. In financial markets, random luck is the simplest explanation of all. A complex, multi-layered algorithmic trading system is a highly complicated explanation for why an account balance increased. Because complex explanations are fragile and prone to curve fitting, the simplest explanation, pure, dumb luck, must be systematically and mathematically eliminated first before we can even entertain the possibility that the algorithm is intelligent.
Wait, I need to push back on a technical detail regarding the boundary of that test.
Sure.
You mentioned earlier that the null hypothesis assumes the expected return is 0 or less. If the null includes 0, -1%, -5%, and an infinite number of negative returns, how does that reduce to the singular testable point of exactly 0 that you just described? That sounds like we're back to an infinite number of claims, just in the opposite direction.
That is a crucial distinction regarding boundary conditions. So while the null hypothesis conceptually encompasses 0 and the entire negative spectrum, we only need to test the highest possible boundary of that state, which is exactly 0.
Okay, explain that.
Picture a high jump bar set at exactly 0 inches. If the statistical evidence demonstrates that the rule possesses enough upward momentum to confidently clear the bar set at 0, then the laws of mathematics dictate it is automatically cleared -2 inches, -5 inches, and everything below it.
Oh, wow, I get it.
By rigorously testing the highest absolute boundary condition, which is exactly 0, we efficiently test the entire negative space in a single mathematical stroke.
That beautifully resolves the boundary issue. We set the high jump bar at absolute 0. But this brings us to the actual execution of the trial. If the historical backtest is the evidence, how does the statistical jury physically measure the weight of that evidence against the 0 bar? How do we build the machinery of this courtroom to arrive at a verdict?
Well, the foundational engine of the courtroom is a concept known as the sampling distribution. This is often the point where amateur quantitative research falls apart, but the mechanics are remarkably elegant.
What exactly is it?
The sampling distribution is a probability curve. Its sole purpose is to map out exactly how much the returns of a totally worthless rule will bounce around the 0 line simply due to the random variability inherent in taking data samples.
Because we have to acknowledge that a worthless rule won't generate a return of precisely 0.00% every single time you test it on a random 5-year slice of market data.
Right.
I mean, if you have a monkey flipping a coin to decide whether to buy or sell the S&P 500 every morning, sometimes that monkey will randomly catch a massive bull run and look like a genius, returning positive 8%.
And other times it will buy every top and return -8%.
So the sampling distribution is the bell-shaped curve that plots out the probabilities of all those random fluctuations.
It visualizes the precise shape and width of luck for that specific environment. And once we mathematically construct that shape of luck, we can define the p-value with total clarity.
The p-value.
The p-value is arguably the most dangerously misunderstood metric in all of finance. Countless practitioners believe the p-value is the probability that their trading rule is a fluke. It is absolutely not that.
What is it then?
The p-value is a conditional probability.
We need to pause and shine a massive spotlight on the phrase conditional probability. What does that mean?
A conditional probability means the metric only exists and only has meaning under the strict assumption that a specific prior condition is absolute truth.
Okay.
The p-value is the probability of observing a historical backtest return as high as the one you got, under the ironclad condition that the null hypothesis is true.
Under the condition that the rule is completely worthless.
Exactly. To put it plainly, if we guarantee, as a law of physics, that your trading rule is completely devoid of predictive power, how often would it accidentally stumble into a 10% return purely through random sampling variance?
Wow.
If you calculate a p-value of 0.04, it means a guaranteed worthless rule would achieve that 10% mark only 4 times out of 100 iterations.
That 0.04 is the mathematical translation of reasonable doubt. If a 10% return only happens 4 times out of 100 by pure luck, the statistical jury can look at the evidence and say the probability of this being an accident is exceedingly low. Therefore, we reject the presumption of innocence. We find the rule guilty of possessing genuine predictive power.
Precisely. But the entire validity of that verdict rests on the accuracy of the sampling distribution. If we don't know the exact shape of luck, the p-value is totally meaningless.
So how do we physically build that curve? The literature highlights 2 computationally intense resampling methods to execute this: bootstrapping and the Monte Carlo permutation. Let's get our hands dirty with the mechanics of bootstrapping first.
Bootstrapping is a revolutionary statistical tool because it frees us from having to make dangerous assumptions about the market. Traditionally, statisticians assumed returns followed a perfect bell curve, a normal distribution.
We know financial markets do not do that. They have fat tails and skewed data.
Yep. Exactly. Bootstrapping gets its name because the original data set essentially lifts itself up by its own bootstraps to build the distribution, completely preserving the weird, non-normal characteristics of the actual market.
Let's walk through the day-by-day mechanics of how a computer actually executes a bootstrap. Imagine your trading rule traded for 1,000 days.
Okay.
You have a spreadsheet with 1,000 rows. Each row is the daily percentage return of your rule. Day 1, up 1%. Day 2, down 0.5%. Day 3, up 2%, and so on. Over the 1,000 days, let's say the average daily return is a positive 0.2%. The very first mechanical step in bootstrapping is to aggressively enforce the null hypothesis by zero-centering that data.
And this zero-centering step is the crucial mathematical translation of assuming innocence. You take that overall mean of positive 0.2% and you subtract it from every single one of the 1,000 daily returns in your spreadsheet.
So day 1, which was positive 1.0%, becomes positive 0.8%.
Right. And day 2, which was negative 0.5%, becomes negative 0.7%. You shift the entire cluster of data downward. The new average of this modified spreadsheet is exactly 0.0%.
By doing that, we've created an artificial parallel universe history of a worthless rule. It makes zero money on average, but it violently swings around day to day with the exact same volatility, the exact same fat tails, and the exact same behavioral quirks as the real market.
Now the resampling engine turns on. The computer reaches into this zero-centered spreadsheet of 1,000 days and randomly selects one day. It records that shifted daily return. Then, and this is the defining characteristic of the bootstrap, it puts that day back into the pool.
Wait, it puts it back?
Yes. This is sampling with replacement.
Why is putting it back so critical? If we just pull them out and don't put them back, aren't we just shuffling the deck?
If you don't replace it and you draw 1,000 times, you will just end up with the exact same 1,000 days in a different order. The mean will still be exactly zero every single time.
Oh, of course.
By sampling with replacement, the computer might randomly draw day 42 3 different times in this new sequence, and it might never draw day 819.
Ah, I see.
The computer does this 1,000 times to construct a brand new alternate 1,000-day history. It then calculates the final average return of this newly generated artificial history. Let's say this specific random draw resulted in a positive 0.5% return. We record that number.
Then the computer wipes the slate clean and does it again. It randomly draws 1,000 days with replacement from the zero-centered pile, calculates the mean, and records it. It might do this 5,000 or 10,000 times.
It is simulating 10,000 alternate realities where the rule has absolutely no true edge, but experiences wildly different sequences of market volatility.
And when you plot all 10,000 of those final averages on a graph, you have physically constructed the bootstrapped sampling distribution. You've built the exact shape of luck for your specific rule in that specific market.
It is a stunningly robust method, and it also allows us to calculate those confidence intervals we mentioned for parameter estimation by finding the upper and lower bounds of this distribution. However, the quantitative community, specifically through the work of Dr. Timothy Masters, developed a second resampling technique that approaches the construction of the worthless rule from a completely different and arguably more elegant angle.
This is the Monte Carlo permutation. Where bootstrapping resamples the final returns of the rule, the Monte Carlo method dissects the rule into its component parts before scrambling them.
Right, and this is where the mechanics get truly fascinating. Let's break down what an algorithmic trading rule actually is at its lowest level. It is nothing more than a time series of decisions.
Over 1,000 days, the rule generates a sequence of market positions: buy, sell, buy, hold, short.
In algorithmic math, that translates to a series of +1 for long, -1 for short, and 0 for flat.
Okay, so how does Monte Carlo use that?
The Monte Carlo permutation takes the actual historical daily price changes of the market, say the exact daily percentage changes of the S&P 500 over those 1,000 days, and detaches them from the timeline. It throws all 1,000 daily market returns into a giant digital bingo tumbler and scrambles them completely.
It's important to note the contrast here. Unlike bootstrapping, this scramble is done without replacement. You are taking the exact 1,000 historical market days, just completely randomizing their chronological order.
Exactly. Once the market returns are scrambled, the computer pairs this randomized market history chronologically against the rule's original static sequence of +1s and -1s.
I want to visualize this because it's so clever. Imagine you kept a meticulous physical diary of your trading. On March 4th, you wrote +1, went long. On March 5th, you wrote -1, went short. The Monte Carlo permutation acts like a time traveler who leaves your diary perfectly intact but scrambles the reality outside your window. So on March 4th, when your diary says you went long, the market experiences the price action that actually occurred on August 12th.
The mathematical elegance of this operation is what it fundamentally destroys. A trading rule makes money because it possesses intelligent timing. It goes long right before the market goes up.
Yeah.
By randomly assigning different market days to the rule's historical signals, you have surgically extracted and annihilated all of the rule's timing intelligence.
But you perfectly preserve the rule's structural biases. If the rule was long 80% of the time, the scrambled version is still long 80% of the time.
Exactly. You've essentially created the ultimate dummy rule. It trades with the exact frequency and bias of your complex algorithm, but possesses zero predictive timing.
So you simulate this scramble 5,000 times. For each scramble, you calculate the total return of the dummy rule, plot those 5,000 returns, and boom, you have a Monte Carlo sampling distribution. It's a completely different pathway to arriving at the shape of luck. Note that you can't use this one for confidence intervals, though, since it tests signal information, not a parameter estimate.
That's a good technical point, and we can see this applied to actual data sets in Aronson's text. Consider a specific strategy evaluated in the literature, labeled Rule TT4-91.
Okay.
Over its historical backtest period, this algorithmic rule generated an annualized return of positive 4.84%.
In the retail trading world, 4.84% might sound unexciting, but in the institutional quantitative space, if you can generate a scalable, uncorrelated 4.84% alpha, you are managing billions of dollars.
But the critical step is validating that 4.84%. The researchers took that rule and subjected it to the bootstrapped sampling distribution we just described, running 5,000 resamples of zero-centered data. When they mapped the 4.84% actual return against the distribution of luck, the resulting t-value was 0.069.
Let's translate that using our courtroom logic.
Uh-huh.
A p-value of 0.069 dictates that if Rule TT4-91 was completely devoid of edge, if it was just a dummy rule, it would still accidentally stumble into a 4.84% return roughly 7 times out of 100 simulated alternate realities purely through random sampling variance.
Right. And in the strict realm of statistical science, a p-value of 0.069 sits in an uncomfortable gray area. It is often labeled marginally significant.
Because it fails to clear the rigorous 0.05 threshold, the 5% probability mark, that most academic disciplines demand before rejecting the null hypothesis.
Exactly.
But I want to challenge the rigidity of that threshold because it brings up the practical reality of trading. If we set our standard of reasonable doubt so incredibly high, if we demand a p-value of 0.01 or 0.001 before we deploy capital, aren't we almost certainly going to throw away trading rules that actually possess a genuine edge?
That is a very real risk.
I mean, if a rule really works, but simply didn't have a massive blowout performance in the backtest, a strict p-value will force us to discard it. In statistical terminology, aren't we guaranteeing a massive amount of type 2 errors?
You've identified the inherent tension in all statistical testing.
Mm-hmm.
A type 2 error is a false negative. It is the tragic act of ignoring a hypothesis that is actually true. You discard a rule that truly has predictive merit.
Right.
The counterpart to this is the type 1 error, which is a false positive. It is the act of accepting a hypothesis that is actually false. You deploy capital into a rule that is completely worthless because a statistical fluke convinced you it was good.
So why do quantitative funds heavily bias their testing to avoid type 1 errors, even at the cost of committing numerous type 2 errors?
It comes down to the asymmetrical risk of ruin.
Break down that asymmetry. Why is one error so much more toxic than the other?
Well, if you commit a type 2 error, you incur an opportunity cost. You leave potential profits on the table, which is frustrating, but your fund's capital remains intact. You survive to research another day.
Okay, and the type 1?
If you commit a type 1 error, you are not just missing an opportunity. You are actively deploying live capital into a system governed by random noise. When you trade a worthless rule in the real market, the friction of transaction costs, slippage, and the brutal gravity of mean reversion will actively erode your principal.
So a type 1 error doesn't just cost you potential upside, it threatens the fundamental survival of the portfolio.
Exactly. Therefore, demanding a punishingly low p-value is a survival mechanism.
That really reframes the entire concept of statistical thresholds. It's not about finding every good rule, it's about absolutely ensuring you don't trade a bad one.
Precisely.
This exhaustive courtroom trial using bootstraps, Monte Carlo permutations, and rigid p-values, works beautifully for evaluating a single, isolated trading rule. We can confidently measure its luck and assess its merit, but this is exactly where our entire diagnostic framework hits a catastrophic wall.
Yes, the transition to Chapter 6.
What happens to the math when we acknowledge how modern algorithmic trading actually functions? Nobody manually tests one rule anymore. I can boot up my optimizer and test 10,000 different moving average combinations before I've even finished my morning coffee.
And when you do that, the courtroom metaphor completely disintegrates. We are no longer testing a single hypothesis. We are simultaneously testing a massive multitude of hypotheses.
And this introduces what is undeniably the most insidious and destructive mathematical trap in quantitative finance: the data mining bias.
It's terrifying. When you evaluate thousands of rules and select the single rule with the highest historical performance, the observed return of that specific winning rule systematically and massively overstates its true future predictive power.
It is a mathematical illusion generated by the scale of the search itself.
Exactly. To understand the mechanics of this illusion, we have to look at the mathematical framework of a multiple comparison procedure, or MCP.
Anytime you run an optimizer, or sweep through parameters, or test a basket of signals, you are executing a multiple comparison procedure.
Right. And this process requires three specific components: a problem you're trying to solve, a set of candidate solutions, which is your massive universe of rules, and a figure of merit, such as the highest annualized return, which you use to score and rank those candidate solutions.
The foundational equation that dictates the outcome of this procedure is disarmingly simple, yet profound. Observed performance equals predictive power, which is the true merit plus randomness, which is the luck.
Yes, and in a massive data mining search, the rule that ascends to the number one rank, the rule that wins the optimization, is almost never the rule with the highest predictive power.
Really?
Really, it is almost always the rule that experienced the maximum positive randomness.
This brings us to our second anchoring analogy. To visualize why the winner is just the luckiest, we are going to look at the classic thought experiment of auditioning monkeys to write Shakespeare.
I love this analogy.
If I take one single monkey, sit it in front of a typewriter, and demand it write a perfect sonnet, it is going to smash the keys and produce absolute gibberish. That is the equivalent of testing a single, poorly designed trading rule. We run the backtest, the return is terrible, our statistical courtroom easily recognizes the gibberish, and we discard the rule. The system worked.
But the dynamic shifts radically when we scale the operation. Imagine you construct a massive warehouse, bring in 10,000 monkeys, sit them in front of 10,000 typewriters, and let them furiously strike the keys for an entire year.
The sheer mathematical force of the law of large numbers dictates that the volume of random combinations will be staggering. Purely by statistical chance, it is highly probable that one of those 10,000 monkeys will randomly strike the exact sequence of keys to type out, "Shall I compare thee to a summer's day?"
Right. And now imagine I am the algorithmic data miner. I walk into that warehouse after a year. I completely ignore the 9,999 stacks of absolute garbage paper. I walk straight to the one monkey that produced the perfect sonnet.
You hold up the paper, declare the specific monkey to be a generational literary genius, and sign it to a multi-million-dollar publishing contract.
That absurd leap of logic is exactly what data mining bias is. You are attributing genuine merit to an outcome that was entirely manufactured by the immense scale of the random search.
And the inevitable tragedy occurs the moment that genius monkey sits down to write its second book, which is the exact equivalent of taking your optimized trading rule and deploying it with live capital in the out-of-sample future.
The monkey immediately reverts to typing gibberish, and your trading rule immediately starts losing money, because the initial performance was a mirage of scale, not a reflection of edge.
This necessitates a deeper look at the environment we are operating in. Why is this bias so uniquely devastating in finance, as opposed to other scientific fields that also use massive computing power?
It comes down to where financial markets sit on what we can call the spectrum of randomness. Visualize the sliding scale. On the extreme left side, you have the hard sciences, pure physics.
Okay.
If you drop a steel ball from a roof, gravity dictates it will fall at a specific calculable rate. The outcome is almost entirely governed by underlying laws. The luck component is effectively zero.
Right.
On the extreme right side of the scale, you have state lotteries or roulette wheels, where the outcome is 100% governed by pure randomness. The merit component is zero.
Financial markets exist uncomfortably close to the roulette wheel on that spectrum.
Oh, very close.
The daily price action of a stock is bombarded by an endless stream of unpredictable variables. Sudden geopolitical news, shifting central bank policies, algorithmic flash crashes, and the collective emotional panic or euphoria of millions of human participants. Because the market is so incredibly noisy, the randomness variable in our equation absolutely dwarfs the predictive power variable.
Exactly. When the underlying environment is dominated by noise, and you deploy a computer to evaluate 5,000 different rules, the variance in the luck component across those 5,000 rules is going to be massive.
Some rules will experience terrible luck, and some will experience miraculous luck.
And because the variance in luck is so much larger than the variance in actual merit, the optimizer will inevitably select the rule that hit the luck jackpot.
This creates a fatal mathematical error in how researchers validate their optimized rules. An amateur quant will take the single best rule out of the 5,000 they just tested, and they will run it through the exact bootstrapped sampling distribution we built during our courtroom analogy.
Which is a huge mistake.
They will evaluate the winner of a 5,000 rule tournament using a probability curve designed for a single, isolated draw.
And doing so completely invalidates the mathematics of the p-value. If you evaluate the best of 5,000 against a single draw distribution, the resulting p-value will look astoundingly significant, perhaps 0.0001. It will look like you've discovered the Holy Grail, but it is entirely mathematically illegitimate.
Because when you are evaluating the single best performance pulled from a massive set, you cannot compare it to the average distribution of single rule. You must evaluate it against a sampling distribution of the maximum mean.
The maximum mean. This is a tough concept, so let's visualize building it.
Okay, let's go back to our warehouse of 10,000 monkeys. If we run the whole one-year typing experiment, we find the one monkey with the highest score. Maybe it typed a full paragraph of Shakespeare. We record that maximum score.
Then we wipe everyone's memory, reset all the typewriters, and run the entire 10,000 monkey experiment a second time.
Again, we ignore the average. We only record the score of the single best monkey from year 2.
If we do this warehouse experiment 5,000 separate times, we build a distribution consisting entirely of the 5,000 best monkeys.
When you plot that specific distribution on a graph, the entire bell curve is shifted radically to the right. The baseline expectation for what constitutes luck is completely redefined.
Exactly. When you take your seemingly genius trading rule that generated a 15% return and compare it to this right-shifted distribution, you suddenly realize that a 15% return is exactly what the mathematics of randomness predicts the luckiest monkey would achieve.
Your rule isn't special. It is simply fulfilling its statistical destiny as the beneficiary of a massive search.
It's a sobering realization.
But wait, if running multiple rules creates this massive, distorting illusion of merit, is data mining fundamentally a broken concept? Should we throw out the optimizers and go back to manually testing one idea a month on a piece of graph paper? Because it sounds like you were saying using computers to search for patterns is inherently a fool's errand.
That's a common reaction. But it is vital to separate the tool from the statistical measurement of its output. Data mining is not inherently bad. In fact, in modern financial markets, it is an absolute necessity.
Why?
Because human cognition is exceptional at identifying linear relationships in low-noise environments. But we are wholly unequipped to perceive the complex, multidimensional, nonlinear patterns buried within decades of high-noise financial data. We must use computers to mine for these configural relationships.
So the flaw is not in the act of mining. The fatal flaw is failing to adjust our statistical threshold to account for the mathematical reality of the multiple comparisons.
Perfectly said. The data mining bias is not an unpredictable ghost. It is a rigid, calculable, mathematical phenomenon. If we can understand the variables that dictate its size, we can adjust our engines to neutralize it.
So if scaling up the computer power inflates this bias, what are the exact levers causing that inflation? It can't just be a monolithic problem. The text breaks down 5 distinct variables that govern the exact magnitude of the data mining bias. Let's explore these levers mechanically. First, and most intuitively, the number of rules tested.
This is a direct relationship.
Yeah.
The mathematical probability of uncovering a massive, spurious historical return increases in lockstep with the number of rules you evaluate. If you only audition 10 monkeys, the best monkey probably just typed a slightly more coherent string of vowels than the others. The bias is minimal.
But if you audition 10 million monkeys, you are going to get Hamlet. Every single additional rule you introduce to the optimizer is another ticket purchased in the lottery of randomness, geometrically increasing the likelihood that one ticket hits the jackpot.
Precisely.
What about the time horizon of the data? What if I lock those monkeys in the warehouse and make them type for a solid decade instead of just one night? This brings us to the second variable, sample size, or the number of observations.
The sample size exerts an immensely powerful inverse relationship on the bias. The more historical data points you use in your backtest, the more aggressively the bias is suppressed.
This is where the law of large numbers acts as our savior.
Exactly. If you evaluate a rule over a short time frame, say 50 trades over 3 months, a completely worthless rule can easily look like a genius simply by catching the right side of a single, highly volatile macro event.
But force that rule to trade 5,000 times over 15 years, through bull markets, bear markets, crashes, and sideways chop. Over that massive sample, the luck averages out to zero. The longer the timeline, the more impossible it becomes for sheer randomness to sustain a positive trajectory.
That's right. Now let's talk about the makeup of the rule universe itself.
Yeah, I'm thinking about that. If I test 50 variations of a moving average crossover, say, I test a 50-day average, a 51-day, a 52-day, all the way up to a 100-day average. I just tested 50 rules.
Technically, yes.
But practically speaking, the 50-day average and the 51-day average are going to generate essentially the exact same buy and sell signals. They are highly correlated. Does the math punish me with 50 distinct penalties for what is essentially just one core idea?
You've organically discovered the third variable correlation among rules, which operates as an inverse relationship. If your candidate rules are highly correlated, the data mining penalty is drastically reduced.
Oh, that makes sense.
Visualize it through the monkeys. If you have 50 monkeys, but they're all looking over each other's shoulders and copying the exact same keystrokes, you don't actually have 50 independent chances to accidentally type Shakespeare. You essentially have one blurry chance.
Right.
The data mining bias only severely punishes you for testing statistically independent concepts. If your optimizer is just sweeping through minor parameter tweaks of a single strategy, the effective number of rules you were testing is vastly smaller than the raw number, shrinking the bias.
That is a critical nuance for anyone doing parameter optimization. The fourth variable addresses the nature of the data itself, positive outliers. We know financial markets exhibit fat tails. We experienced 2008. We experienced the 2020 pandemic crash and the subsequent massive V-shaped recovery. How do these extreme outlier events impact a multiple comparison search?
Outliers have a direct, amplifying relationship with the bias. The presence of massive, sudden price jumps provides a fertile breeding ground for spurious results. If your data series includes a few days where the asset jumped 15%, a completely random, worthless rule might accidentally be holding a long position on those specific days.
And those few accidental massive wins completely skew the average annualized return for the entire 10-year backtest. The rule looks like it has an incredible edge, but it just happened to be standing outside with a bucket when lightning struck.
Exactly. The fatter the tails in your dataset, the easier it is for an optimizer to find a rule that randomly caught the outliers.
Which leads us to the fifth and philosophically most fascinating variable, variance in true merit. This factor has an inverse relationship with the bias, and it poses a critical question about the underlying reality of the rule universe. We have been assuming that all the rules in our search are worthless, that all the monkeys are equally talentless. But what if one of those monkeys actually possesses genuine literary brilliance?
What if there is a hidden Shakespeare in the warehouse?
It's exactly.
If your vast universe of rules contains even a single algorithm that possesses profound, genuine predictive power, meaning there is high variance in true merit across the universe, that genuine edge will act like a signal piercing through static.
True predictive power is a heavy, consistent force. It will overpower the volatile fog of randomness.
Right. The superior rule will ascend to the #1 rank in the optimization, not because it got lucky, but because its inherent merit mathematically dominated the luck of the other rules. When variance in true merit is high, the winner of the search is highly likely to be the actual best rule, severely mitigating the impact of the data mining bias.
Okay, so we have the theoretical framework. We know the bias is governed by the volume of rules, the sample size, the correlation, the outliers, and the underlying merit variance. But theory only gets us so far. How does a quantitative researcher actually execute a solution that accounts for all these variables simultaneously?
The text details specific mathematical architectures designed to survive this environment. Let's break down the mechanics of the first major solution, walk-forward testing.
Walk-forward testing is a highly pragmatic, structurally rigorous method for generating out-of-sample performance metrics without sacrificing data. The amateur approach to out-of-sample testing is simply cutting the data in half, optimize on the first 5 years, then test the winner on the last 5 years.
Which is very limiting. Walk-forward testing is much more dynamic. It involves sliding a data window forward through time in discrete segments or folds.
Let's build a concrete narrative example of this sliding window. Imagine you have a decade of daily data for the S&P 500, from 2010 to 2019. You don't dump the whole decade into the optimizer. You define a training window, say 4 years, and a subsequent testing window of 1 year.
Exactly. So for fold 1, your computer optimizes your thousands of rules strictly on the data from 2010 through 2013. It finds the single rule that performed best during that specific 4-year environment. You take that winning set of parameters, lock them in, and immediately execute them blindly on the data from 2014. You record the daily returns of how it performed in that previously unseen 2014 environment.
Then, the entire structural window slides forward by 1 year. For fold 2, the computer completely forgets the previous optimization. It now trains the rules on the data from 2011 through 2014. It finds the new optimal parameter set for that specific period, locks it in, and trades it blindly through 2015.
And you record the 2015 returns. You repeat this sliding process training on 2012 to 2015 to test on 2016, training on 2013 to 2016 to test on 2017 until you run out of data.
The brilliance of this architecture is what you do with the results. You take the blind returns from 2014, 2015, 2016, and stitch them all together chronologically. You have created a continuous multi-year equity curve that is entirely composed of out-of-sample data.
Because the parameters used to trade in 2015 were mathematically blind to the price action of 2015, this stitched-together track record provides a vastly superior estimate of how your entire data mining process will perform in the real unknown future.
But I have to push back here because this is where I see people contaminate their own research. If you run a walk-forward test over that whole decade, stitch the out-of-sample data together, look at the final equity curve, and decide you don't like the result, what happened?
I know exactly where you're going with this.
Right. Many people will go back, change the length of the moving average in their initial rule universe, or change the training window from 4 years to 3 years, and run the whole walk-forward test again to get a smoother final curve. Aren't you just committing a meta-level data mining bias? Aren't you just optimizing the out-of-sample data itself?
You have identified the exact trap that ruins many sophisticated algorithms. Look-ahead bias at the meta level. If you tweak your architecture based on the final out-of-sample results, your out-of-sample data instantly becomes in-sample data. It is mathematically contaminated.
So how do you avoid that?
True walk-forward testing requires draconian discipline. The specific architecture, the size of the training window, the step size, the rule universe must be locked in stone before the computer runs the first fold. You must accept the first stitched-together track record as the absolute truth of the system's viability. If you iterate on it, you destroy the validity of the test.
Wow. It requires an iron will to accept a bad result and walk away from the code. But for institutional practitioners who require the absolute apex of statistical rigor, the text outlines an even more mathematically devastating weapon against the bias. This is the heavy artillery Halbert White's reality check, commonly referred to as WRC.
White's reality check is a masterclass in computational statistics. It is a highly advanced bootstrapping algorithm specifically engineered to solve the multiple comparison problem mathematically. Remember how we built a bootstrap sampling distribution for a single rule by zero-centering its returns and drawing random samples?
Yes, to enforce the null hypothesis.
Exactly. WRC scales that exact logic to encompass the entire data mine universe simultaneously.
Let's construct the mechanics of WRC. Imagine a massive spreadsheet. You have 5,000 columns representing the 5,000 different rules you just optimized. You have 1,000 rows representing the daily returns of each rule over the backtest. You know that Rule 42 won the optimization with a 15% return.
Okay.
To run WRC, the computer first goes to the bottom of all 5,000 columns, calculates the exact mean return for every single rule, and subtracts that specific mean from every daily return in that rule's column.
By executing that independent zero centering across all 5,000 columns, the computer has simultaneously forced the null hypothesis upon the entire universe. You now have a massive matrix simulating 5,000 completely worthless rules that perfectly retain their individual volatility, their correlation to one another, and their exact historical exposure to market outliers.
Now the computer begins the resampling engine, but it does it across the entire matrix at once. It randomly draws a day, say day 412. It records the return for all 5,000 rules on day 412.
Then it draws another day, with replacement, maybe day 88. It records the returns for all 5,000 rules on day 88. It builds a completely scrambled 1,000-day alternate history, applying the exact same sequence of scrambled days to every single rule simultaneously.
This simultaneous time scramble is the genius of WRC. By keeping the days aligned across the columns during the draw, WRC perfectly preserves the complex cross-correlation between all 5,000 rules.
Exactly. Once that first alternate history is built, the computer calculates the new scrambled mean return for all 5,000 rules. It scans across the bottom of the matrix, finds the single highest performing rule in that specific scrambled universe, and records that maximum value.
It doesn't care which rule won, it just records the highest score of the luckiest monkey in that alternate reality. Then it wipes the matrix, draws a new sequence of 1,000 random days, applies it to all columns, finds the new winner, and records that maximum score. It does this 5,000 times.
By plotting those 5,000 maximum values, WRC physically constructs the elusive probability curve of the maximum mean. It builds the exact mathematical shape of how the luckiest possible outcome behaves across a correlated search space of 5,000 variables.
Finally, you take the 15% actual historical return of your supposedly genius Rule 42, and you plot it against the WRC distribution. If Rule 42's return sits comfortably inside the fat belly of that right-shifted curve, the math proves your rule is just noise.
But if Rule 42's return sits far to the right, beyond the extreme tail of the maximum luck distribution, well, then you have found something truly profound.
The text also notes that you can achieve a similar architectural feat by adapting our previous method, creating a multiple Monte Carlo permutation. Instead of bootstrapping the returns, you scramble the underlying daily market price changes and apply that single randomized market history against the 5,000 distinct signal histories simultaneously. You find the maximum dummy return, record it, and repeat.
Whether you use WRC or the multiple Monte Carlo, the conceptual victory is the same. By building a distribution of the maximums, we mathematically quantify the exact magnitude of the data mining bias for our specific correlated search space. We neutralize the illusion of scale.
We have journeyed through some incredibly dense foundational mathematics today. Let's synthesize the architecture we've built. We began by constructing a rigid statistical courtroom for a single algorithmic idea. We used the null hypothesis to forcefully assume worthlessness, and we utilized bootstrapping and Monte Carlo permutations to map the exact shape of random sampling variance, establishing a p-value threshold to separate edge from luck.
But we immediately recognize that modern computing shatters that single-rule courtroom. When you unleash an optimizer to search through thousands of parameters, you introduce the data mining bias. The sheer volume of the search guarantees that the rule with the highest observed performance is almost certainly the rule that simply experienced the maximum positive randomness.
We then explored the specific mechanical levers that govern that bias, how the number of rules and fat-tailed outliers inflate it, while deep sample sizes, high parameter correlation, and genuine underlying merit act to suppress it. Finally, we unpacked the heavy machinery walk-forward testing and White's reality check, which allow us to mathematically model the luck of the entire universe simultaneously, shifting the benchmark of significance to account for the scale of our search.
Understanding these interconnected engines fundamentally alters your relationship with historical data. A back-tested equity curve is no longer a marketing document or a cause for celebration. It is merely an initial, highly suspect claim that requires an immense, multi-layered burden of statistical proof before it can be trusted with capital. And this realization provokes a deeply complex thought as we look at the bleeding edge of quantitative finance.
What does this mean for the future of the field?
As the industry rapidly transitions from linear parameter optimization into the era of fully autonomous deep learning AI models, the architecture of the search itself changes. A neural network doesn't just test 5,000 distinct rules. It implicitly evaluates millions, perhaps billions, of complex, nonlinear configural relationships within the data every single second. It constantly prunes and weights these relationships without human oversight.
Wow.
If the number of rules tested effectively approaches infinity, does the mathematical calculation of the data mining bias eventually break down? Or, more optimistically, will these models learn to internally generate their own implicit reality checks, dynamically penalizing their own discoveries for the sheer scale of their internal search before allocating capital? In a landscape where machines can generate and test an infinite matrix of hypotheses, your manual, rigorous understanding of the underlying math, the logic behind White's reality check, might be the only cognitive defense you have against an AI endlessly mining its own fool's gold.
That is a staggering implication. If the computational engine is running at a billion miles an hour, you better have an intimate understanding of exactly how the mathematical breaks function. So I want you, the listener, to look critically at your own diagnostic environment this week. Whether you are evaluating your own algorithmic trading models, reviewing backtests from a vendor, or even analyzing massive data mining sweeps in your business analytics. When you see that perfect chart going up and to the right, force yourself to ask the hard question. Are you looking at genuine predictive merit, or are you just staring at the luckiest monkey in the warehouse? Do the math. Put the baseline assumptions on trial. And above all, stay curious.